Trending indicators usually suffer and perform terribly in ranging markets. Why, you may be thinking? Well, it's because these indicators, like the moving average, can do a pretty good job when the market is trending. But as soon as the market starts ranging, they end up giving a bunch of false bullish and bearish signals. This can lead you to lose all your money. But how can we avoid this? Well, one effective method is to incorporate the volume of the price into your analysis. To do that, you would need a trend indicator that can seamlessly blend both trend and volume into one cohesive system. And this is where the Volumatic VIDYA indicator comes into play. This powerful tool doesn't just show you the trend, instead, it also reveals the volume at different levels of that trend. In this video, we're going to go over what this indicator really is. So, with that being said, let's get started. To get started with this indicator, you want to go to Tradingview, and then open any trading security that you like, because it works on all markets. Next, open the Indicator Search tab. Type in Volumatic Variable Index, and it's going to be this one by Big Beluga. This is the all-powerful Volumatic Variable Index Dynamic Average Indicator. A pretty long name, but thankfully it can be abbreviated as VIDYA. For the rest of this video, I will be calling it the VIDYA indicator. So what exactly is it? Well, it's a tool designed to provide traders with a dynamic view of market trends and volume analysis. By combining the adaptability of the variable index dynamic average with volume analysis, it offers insights into both the trend direction and the underlying strength of price movements. In short, it not only identifies trends in the market, but also visualizes buying and selling volumes within each trending phase. This indicator is made up of the following components. The first and most obvious is the VIDYA line, which forms the trend cloud. Whenever the VIDYA line is green, it indicates that the market is bullish. Conversely, if the VIDYA line turns red, that would indicate that the market is bearish. To help you spot transitions between bullish and bearish trends, there are up and down arrows. As you can see here, a green upward arrow indicates the onset of a bullish trend, while a red downward arrow indicates the onset of a bearish trend. Now, looking at this indicator, you will also notice that we have this table right here, with labels for buy volume, sell volume, and delta volume. Let's explain what this table does. Here, we have a bullish trend. The buy volume means that throughout this bullish trend, the total volume for all the bullish candles was 8.9 million, while the sell volume for all the bearish candles was 6.5 million. Now, the delta volume is just the difference between the buy volume and the sell volume expressed as a percentage. So for this particular bullish trend, the delta volume was 30.7%. It's essential to remember that these numbers are not overall figures. They only apply to the current trend you're in. Right now, we're in a bullish trend, which means these numbers reflect this specific bullish phase. If we were to switch to a bearish trend, the numbers would be different. In this bearish trend, the buy volume would reflect the volume for all green candles here, the sell volume is the volume for all red candles, and the delta volume is the percentage difference between the buy and sell volumes within this specific trend. For a bearish trend, the delta volume is supposed to be negative. The more negative this value, the higher the sell volume, which makes the market ideal for taking short positions. Conversely, in a bullish trend like here, the delta volume is going to be positive. The bigger this number is, the higher the buy volume, making the market ideal for taking long positions. Now that we know what this indicator is made of, and most importantly, how the volume functionality works, how can we use it to trade? Well, I'm going to show you right away. There are two methods of using this indicator to trade, depending on the market type. Number one, trending markets. Number two, non-trending or ranging markets. Let's start with trending markets. In a trending market, this indicator can be used for two main purposes. The first and most obvious is trend identification. If the trend cloud is green, the trend is bullish. If the trend cloud is red, the trend is bearish. The second use of this indicator in a trending market is to identify the strength of the trend using this table. So here we have a bullish trend. And it's not just bullish, it's a strong bullish trend. Looking at the table, you can see the strength of this trend reflected in the delta volume, which is 67%. In my experience with this indicator, whenever this number exceeds 50%, that usually indicates a strong bullish trend. And when using this indicator to trade, you want this number to be as high as possible, preferably over 50%, or at the very least 30% for a decently strong trend. But always remember, the higher this number, the stronger the trend, which also means the higher the probability of profitable trades. This number can actually go as high as 200%, although it's highly unlikely because reaching that would require an unbroken sequence of bullish candles. Now here, we have what I call a moderate bullish trend. As you can see, the trend is still bullish because the candles are going higher and higher. Looking at the delta volume, you can see it's only 10%. This means the amount of buy volume and sell volume were almost equal. A trend like this will most likely result in trades taking longer to hit take profit. And overall, you're probably going to lose more than you win when trading in such a trend, because the market can shift to ranging at any moment. In my experience with this indicator, whenever the delta volume for a bullish trend drops below 10%, it is no longer a trending market. It becomes a ranging market disguised as a bullish trend. On the bearish side, here we have a decently strong bearish trend, as you can see. The delta volume is negative 46%, which is under our limit of negative 30%, but not quite under negative 50%, yet still decent enough to be usable. Keep in mind that for bearish trends, you want this number to be larger, toward the negative side. The more negative, the stronger the trend. This value can go to negative 50%, negative 100%, or even all the way to negative 200%. If it gets closer to zero, the trend weakens. For example, on this chart, you'll notice the market experiencing a pullback with more green candles appearing. This causes the delta volume to become less negative, signaling a weakening trend. Eventually, if this continues, it can indicate a potential trend reversal. This brings us to another important application of this indicator, identifying trend reversals. In a bullish trending market, the delta volume value will get smaller and smaller toward the end of the trend. Whenever that happens, it's a signal that the market may be reversing soon, which means if you had any long positions, now would be a good time to start exiting. As you can see here, the delta volume got smaller and smaller until eventually the trend shifted to bearish. So that concludes the applications of this indicator in a trending market. The second type of market where this indicator is useful is a non-trending market, also known as a ranging market. So how do you identify a ranging market using this indicator? Well, we're going to use both the trend cloud and the delta volume. Whenever the delta volume is less than 10% and close to zero, it's a strong signal of a ranging market. Right here, we have a ranging market, but the trend cloud is colored green, which would typically indicate a bullish trend. If you were to follow this indicator blindly, you might take long positions here and probably end up losing your money. However, by checking the delta volume, which is 4.2%, less than 10% and close to zero, you get a clearer picture. A low delta volume like this tells you that this is not a bullish market, it's a ranging market. If you were to take any long position here, you'd see the price eventually heads down, likely stopping you out. So this indicator is basically going to be a savior in such market scenarios, helping you avoid unprofitable trades. Now remember, when the trend cloud is green, the delta volume is usually positive, but it can even go negative despite the green trend cloud. Just know that as long as this value is less than 10% all the way to negative, the color of the cloud wouldn't matter because it would mean that the market is ranging. The opposite logic applies when the cloud is red. If the delta volume is close to zero or positive, the color of the cloud doesn't matter, as it still indicates a ranging market. Here, the trend cloud was red, which typically would be considered bearish. But since this is not a moving average, we have a feature that helps us avoid trading in such markets. By looking at the delta volume, which is at 11.2%, we can see that this is not a bearish trend, but rather a ranging market. Now, I'm going to show you a simple method we can use to trade with this indicator. For a long trade, ensure that the trend cloud is green, indicating a bullish trend. The second condition is that you want the price to retest the most recent pivot low as indicated by the VIDYA indicator. Here we can see the most recent pivot low. If we extend this to the right, we can see that the price has retested it. A retest is valid if a candle touches the level with a wick, whether it's a green candle like here or a red candle. In this case, the retest candle was green, making this a valid setup. If a red candle had touched it first, we would need to wait for the next candle and ensure it's green before considering the trade. Lastly, we need to ensure the momentum for this position is super strong by looking at the delta volume, which needs to be 30% or above. Here it happens to be 39%, which is decent enough, making this entry valid. Then we take a long position, place the stop loss decently under the entry candle, and set the take profit at 2 times the stop loss. Letting the trade run, you can see that it was profitable, and it's as simple as that. Identify a bullish trend, wait for the price to retest the most recent pivot low, with a candle touching the level with a wick, without closing under it, and then confirm strong buy volume by checking if the delta volume is above 30%. Do the opposite for short positions. That's it for this video. I hope you found some value. If you did, hit the like button below and consider subscribing and turning on the notification bell to stay tuned. Thanks for watching. See you next time.